welcome to the show where I talk about stocks that are interesting. My name is Michael Duke. If you find stocks that are interesting to be interesting, well, then please consider liking this video and subscribing to the channel. All word salad aside, very busy day today. There were many companies in the portfolio that released earnings yesterday and a few today as well. Notably, today we have RSG. So, yesterday I made two videos reviewing earnings. I reviewed Philip Morris and Carlisle companies. If you follow those companies and you're interested in my thoughts about earnings, be sure to check out those videos. But what I'm doing today is I'm going to cover these three companies. And in this video specifically, I'm going to be discussing Otis worldwide, company that we've covered in several videos and several articles even. And if I'm feeling up to it and have extra time, I'll cover Texas Instruments as well. Have not made a video or article about that up to this point. So couple of things about Otis. I recently made a video about Otis 4-ish weeks, about a month ago. And then I also wrote an article. I actually, in Seeking Alpha, I upgraded the stock from a hold to a buy. And as you can see, the timing of that was horrendous because immediately after, that was essentially when stocks just sold off like crazy on the heels of Liberation Day. But notably, what's gone on in the time since, you see here, this rating upgrade has aged somewhat poorly so far. It's only been a few weeks, but we see here that it's meaningfully underperformed the S&P 500 by almost 11, more than 11 points. And yesterday, when they released earnings, the stock sold off significantly, sold off 6 or 7% on the earnings report. So I want to discuss my reaction to the earnings. I have yet to pour into them and take a look at what we're dealing with. But one thing that I would like to note before we get into it is that this particular company, it's very tricky. And the reason that it's tricky in the current environment is because although it has very defensive properties and it has very sticky service revenues. In fact, the service business accounts for about 85% of the profits of the business. In the two articles that I've written on here, I really, flesh out how that looks using the company disclosures and all that. So if you haven't, looked at my previous videos on Otis, I recommend that you do that, and also that you read my articles here on Seeking Alpha Premium. If you don't have Seeking Alpha Premium, then my viewers get access to a discount. I'll put the link in the description. But the thing that is tricky about this stock is China exposure, okay? China exposure. This is not a broadly covered company on here, but there's two businesses that Otis has. There's the new construction, and then there's the services business. And the new construction business is obviously more cyclical and based on really commercial building demand. As you might be able to surmise, the primary growth drivers of that business are outside of the United States, particularly in China. China has been a large driver of growth for Otis over the years. And what we're seeing is that in some ways, the stock is trading a bit. It has some correlation to the Chinese market, the Chinese stock market. Of course, these months here, we saw that there was a lot of bullish sentiment around Chinese stocks. The Alibaba and Pinduoduo. I think Alibaba went up by 50% leading up to the trade war. Now, the world did change meaningfully 3 weeks ago on the tariff news, and so I think we have to look really critically at this holding and really be highly skeptical about managing our downside here. So I just wanted to paint everything with my comments there. But we see here, the stock was trading close to $100 a share until they released earnings, and now it's below 93. It has not broken out or broken down out of the long-term uptrend here, but it definitely is testing this channel here. In fact, if we normally I don't do technical analysis this early in the video, but pretty easy to see here that the stock has essentially been trading sideways since April of 2024. So about a year now that we've been into this. You see here that it's been trading within this range between between $90 and $105. So roughly 15 to 17% deviation there, which is fairly low volatility actually. But yeah, the stock has kind of been stuck in purgatory the last year, and again, China has been the driver of that because the narrative around China, all throughout this period here, the narrative of China that kind of dampened enthusiasm of the stock initially and sent it range bound here. The driver of that was recession in China. Lots of recession indicators. You had the big builder Evergrande went bankrupt, and you had all this stimulus that they were providing and all that. Well, it got really bullish here because there were these, all these signs that we were emerging from that. You had like, deep seek, all these signs of Chinese technological transformation, and this stock just kind of caught a bid, and it hit new all-time highs through the midst of that, but since has failed to break out of that, and now we're at the low end of that range. So I think technically speaking, we're definitely in somewhat of a tenuous position here. We need to be skeptical. So, anyways, I would like to now take a look at the earnings report. Again, the stock crashed by 7% or so on the news yesterday. So the market did not like what they saw, obviously, and I want to make my assessment of it now here. Okay, so Q1 25 earnings call. Solid performance to start the year. Service sales up 4% and modernization up 10%. Modernization means the modernization of existing elevator systems. So it's somewhat a blend of the service business and the new construction business. It's more like the new construction business, however, because it is a project-based source of income, whereas the service side is more of a recurring, sticky source of revenue and the driver of their margin expansion and profits. Modernization orders up 12% and backlog up 14% at constant currency. Margin expansion in both segments, notably service expanding 40 basis points, which is obviously good. New equipment expanded 20 basis points, which that's an even better sign. I would actually expect margin compression in new equipment. We had adjusted earnings per share up 5%, which is a good segue for me to discuss dividends here. They did increase the dividend. They raised the dividend by 8%, which is very strong dividend growth, far in excess of inflation, 2 to 3 times what the consensus inflation expectations are right now. So very strong. But one thing that we need to discuss there is that it's notably lower than historical dividend increases. In fact, the first dividend they paid was 20 cents, and they increased that dividend by 20%. to 24 cents. They increased that dividend by more than 20% to 5 cents growth here. They increased again by another 5 cents, so mid-teens increase, and then they increased again by another 5%, so another mid-teens increase. So this increase is at the lowest percent or the lowest cents per share dividend increase that they've ever had. It is also the first dividend increase that is not double digits. So while it's still a very, very strong dividend increase, it is noticeably lower than the history of the stock. I think we need to pay attention to the fact that the dividend growth is noticeably slowing. So we raised the dividend by 8%, but earnings per share was up 5%. So again, our payout ratio is increasing here, which isn't necessarily problematic because they have a fairly low payout ratio, less than 50%, which is low for a company of this maturity. But again, those are signs that we don't necessarily love. And adjusted free cash flow of 186 million, up 20%. So they repurchased $250 million of shares. Again, here where they talk about the dividend, as I already discussed. So here's a few of the recent orders that they've gotten here. They're doing the elevator in Christ the Redeemer, the subway system in Stockholm, the Prestige Tower in Mumbai. That looks like new construction there. Pretty cool. And then the Hangzhou Metro in China. So you get an idea of the geographic diversification. That's definitely a very good quality of the stock, with the China risk aside. The fact that we do have a significant amount of our revenues in euros is, I think, a good quality in this environment where we're seeing dollar weakness. I've talked about this with the Philip Morris stock. I've talked about it with Corteva. A couple of the videos I've made lately, I've talked about how a theme of 2025 so far, and conceivably throughout the rest of the year, is that the dollar is weaker this year, which should augment earnings for companies that have a significant amount of their revenues in non-denominated in dollars. Particularly strong when it comes to euros, which we know that Otis has a significant amount of their revenues in euros. So, anyways, orders is new equipment and modernization. So you see here, new equipment and modernization total up 2% year over year, still pretty good. But we do see, with the double-digit increase here in modernization orders and backlog, and a low single-digit pullback in new equipment orders and backlog. What does that tell us? Well, it tells us that the orders portfolio is significantly, the size of the new equipment business is a lot bigger than the modernization business. So all these are good numbers here. These, this overall number, not outstanding. This right here is what we want to see. Again, remember, 85% of our profits are derived from the service business. So when we increase the amount of units in our service portfolio, even in low to mid single digits, that really drives profits significantly. So here we see how sales, again, currency headwinds were a theme of the first quarter. I expect FX conversion to flip the other way and become a tailwind out throughout the rest of the year. And even if that doesn't fully take shape, I definitely think that'll be the case in the second quarter, where we see a tailwind to FX here. But ultimately, organic sales were flat, and we still had a fairly strong dollar in the quarter. So, sales contracted by 3%. And then we see here, adjusted margin. We did have some margin expansion and profit. Although on a GAAP basis we decreased, our adjusted numbers are relatively flat. And this is where they were talking about the 40 basis points of expansion. And then here we had 4 cents per share of adjusted EPS growth. Again, you see the only detractor here really being driven by currency headwind. Notably here, again, as we've covered multiple times when it comes to this stock, significant amount of buybacks. In fact, they said that in the quarter, they repurchased 250 million of shares. We had a stock price ranging from the low 90s to 105 throughout that time. If we take we just kind of say that it's a $40 billion market cap, it's 1/4 of 2.5% is what that comes out to. So I want to say that's 0.625% of the total float being retired. So you do see how, again, as is a theme with this stock, the share repurchases are really driving a lot of earnings per share growth. And I expect that to continue. That's something that is good and bad. Good for shareholders, of course, good for the strength of the business are a good sign, but also a sign that our economic profits are not as strong as the per share earnings. We're somewhat financially engineering our results. Just something to be aware of, I think, when looking at this company and many companies, but particularly this company. Now we break it down into service segment. We see here, again, we had organic was 4%. I believe organic means prior to currency adjustment. And then, what that translates to is 1% in dollars there. Um, Maintenance and repair up 3%, modernization up 10%. So operating profits went up by 3%, and operating profit margin up to 40 basis points. Volume, pricing, and productivity. Not sure how they measure that exactly, but those were all positives versus labor and material costs and mix. So one thing to keep in mind: labor and material costs. There's our the material costs are tariff exposure potentially, depending on the geography where the units are located and where we're sourcing materials. Um, but that is complex enough to not easily be able to treat out without more granular financial information. Okay, so now we break it down into new equipment, and you see here organic sales. Organic sales down, and again, currency headwinds made it worse. America's down 7%, EMEA up 6%, which is interesting. Asia down 14%. EMEA, of course, means Europe, Middle East, and Africa. So the fact that we have Asia as our primary growth driver, very interesting to see here. Asia Pacific up roughly 10%, China down more than 20%. I think this is a big driver of the stock sell-off right here. Kind of an ominous sign. I think we will get back to that and discuss that near the end of the video. But overall, these numbers don't look great. However, they did have better profit margins in the quarter versus the prior year. You see here mid-single digit profit margins versus 24-25% profit margins in the service segment. So again, the new equipment, you see even the sales roughly being 1/3 of their total sales here versus 2/3 in the service segment. So the new equipment business is low moat or no moat and subject to more volatility and has lower margins. However, very important to pay attention to the results because they are somewhat leading indicators as well, because the amount of service units that they have, I think it's reasonable to assume that the service unit growth is somewhat correlated to the new equipment growth, albeit with a lag. Um, Anyways, so productivity and commodities were a tailwind. versus pricing, volume, and mix, either flat or down. So these numbers, they don't. There's no necessarily reason to panic here, I would say, but yeah, they don't look good, and particularly here. But I think again we got a bright spot here, and that the bright spot there is, I think, largely reinforced by currency tailwinds that I expect through the end of the year. We see here that new equipment unit growth they expect to decrease mid-single digits, and they only expect EMEA to be up, but albeit by low single digits, whereas Asia really seeing a significant contraction in new equipment unit growth. That shouldn't be surprising to anybody here, but definitely not what we want to see. And then we see industry installed base unit growth. So they're still saying that they actually expect uh, installed base unit or service units to increase. And this is industry, not specific to their company. So these need to be filtered through market share. But what we're seeing here is that they do expect growth of mid-single digits in Asia. So, notably, they did guide to 800 million of share repurchases. They exceeded their guidance there by $50 million. So, what that might indicate is that they were a little opportunistic about scooping up shares at the low end. However, I believe they're probably only approved to buy back 800 million of shares, or that's what they plan to do. But we see here that they plan to spend about half of free cash flow on share buybacks. It kind of reaffirmed their new equipment guidance, but changing these numbers around in each of these buckets. In fact, each of these buckets here, they guided to up a little bit, a few basis points. We see before they were saying America's down low single digits, now they're down mid single. So that's they're worsening their outlook there. EMEA, they're saying up low to mid single. They're saying up mid single. So that is that they're expecting better than expected prior in EMEA. But then here, this is the kicker, down mid single in Asia. So the outlook in Asia, particularly in China, is worsening. And then we see here they lowered their guidance on service sales somewhat, but they do expect actually stronger growth in modernization. And while these buckets are identical here, I would say that they revised their guidance down somewhat based on what I'm seeing here. And then here we see again prior outlook. Here they expected constant currency adjusted operating profits X 2025 tariffs up 120 to 150 million. They guided that down. They're saying with tariffs, they reaffirmed that outlook there. Take a look at the difference here between the impact that they expect tariffs to create. So one thing we discussed in the prior video was that it is, tariff resistant. What we are, being reminded of and reaffirmed of is that tariffs might be more significant of a disruptor to the business than what we're seeing. Here, they are revising, I believe, here. They're actually now expecting there to be the currency tailwind here, roughly 5 cents a share. And here they're guiding right here tariffs to be an impact 14 cents to 10 cents there. So that gives you an idea of what we're dealing with. So they're already baking this into their guidance, but they're saying with currency tailwinds, that somewhat evens it out along with better volume, productivity, and pricing. So we see currency exposure. We see 30% in US dollars. Dollars are getting weaker or have softened. Euro has appreciated quite a bit against dollars, so that's a positive. Yen is somewhat flat, but of course, those are diametric opposing forces: the dollar and the Chinese yen, and then another third elsewhere, likely in South America. I think it was appropriate that the stock sold off quite a bit based on these earnings reports, and I commend the management for taking the time to incorporate tariffs into their earnings. But I think just a few weeks ago I had said and stated that I was cautiously optimistic heading into earnings. I think based on what we're seeing here, I have to revert back and I have to downgrade it back to a hold from a buy. I think while the business is very stable, particularly the service business, kind of a mixed bag of results, what we are seeing is that there is a slowdown. The slowdown in China and in Chinese new construction is, if anything, can expect it to get worse. But I also think you have this additional layer of risk now introduced by the trade war tension. You see all of the rhetoric being blasted back and forth between our administration and between the CCP, where the CCP is saying we're going to fight to the death against these tariffs. We're going to take whatever measures possible. We're never going to, give in on this trade war stuff. I think we have to pay attention to that. That's really the big risk here, is that Otis's ability to perform business in China, the longer that the trade war carries on without a resolution, and furthermore, if it were to snowball into a much worse situation like kinetic war or a really pronounced, deep, bad trade war, that would be bad for business with this stock. So I have to downgrade it for sure to hold away from buy, and I think even more so, um, an additional layer of caution there. So I think the timing of my most recent analysis on Otis was exceptionally poor. It's also aged very poorly, and it just happened to hit right in that zone, right at that moment of where so much changed very quickly. And I think out of all the stocks that I've covered, this is probably one of the ones that is most in the crosshairs by me, laser focus of understanding what how the trade war impacts it. So yeah, I have a hard time feeling bullish now after taking a look at the earnings. Um, you know, here the headline here in Seeking Alpha: Otis worldwide shares decline as tariffs lead to fewer Chinese orders. So they're actually attributing the slowdown there to tariffs. In the headline, I don't necessarily see a quote here in this article. We might be able to find that if we take a look at the earnings transcript. So let's just do that real quick before we conclude. We see 34 mentions of tariffs in the earnings call transcript. It's important to highlight that our service business, which represents approximately 90% of our segment operating income, is largely insulated from the impact of tariffs. However, given the current tariff rates, we anticipate that our new equipment business will be adversely impacted. So they're saying, yeah, our new equipment business will be impaired somewhat by this. As you know, Otis primarily sources and manufactures locally through our 17 factories around the world. Our factory in Florence, South Carolina, primarily serves our operations in the US and Canada. For some components, however, there are no local suppliers, and we source parts from suppliers based in China. So that isn't even about the business that is located in China. That is about the domestic business importing components from China. So that's a critical detail, right? In addition, we import some lower volume products to the US. These lower volume products represented well below 1% of our total units sold. That said, if tariffs on our Chinese imports continue at current levels for the remainder of the year, we expect a negative impact of approximately 45 to 75 million to our operating profits, 2025, inclusive of our mitigation efforts. Furthermore, our global manufacturing footprint and standard product platforms give us the flexibility to shift production and adapt to the most cost-effective model moving forward. Please refer to slide 15 in the appendix for additional details on tariffs. So let's take a look at that. Slide 15 is tariff impact and exposure. Okay, so here we have our breakdown of the separate tariffs on U.S. imports of China. An annual an incremental annual impact of $90 million on the tariffs, and then the 10% tariffs on the remainder of the countries is roughly 10 million. So they're saying there's $100 million of tariffs, tariff exposure. Tariff impact of 60 million in 2025 from current backlog included in outlook. So what are they doing? Customer and supply chain negotiations, U.S. supply chain localization, contract language protection. So, and then they're evaluating the long-term strategies of production localization for select products, international sourcing changes. So all of that sounds like a mixed bag of what we should probably come to expect from tariffs and what we should be taking a look at here. But yeah, I do believe that what we discussed prior, where it's largely insulated from tariffs. I think the better way to reframe that is that the service business is largely insulated from tariffs, whereas the new construction business is materially impacted. And then you see how the 8% increase in the dividend gives you an idea of the management's level of confidence going forward for the forward year. They are still confident that the service business will continue to print money. However, their outlook is changed. So very, very, very significant results that are worth paying attention to. So while I still think that this is an excellent company and an excellent management, and the growth story here in the share price and in the cash flow growth over time is far from over, I'm definitely much more cautious after reading this earnings report, and I have to change it to a hold. And I think it's imperative that investors monitor how the outlook is changing as we go forward through the next few quarters. So we already did our technical analysis earlier, so I don't want to rehash that. Very straightforward. The stock price is trading at the near the support level. It did hold at the support level in the low 90s. We're kind of back to pretty much we're near the 52-week low here. So it's certainly attractively valued, and now we have a dividend yield approaching 2% with strong growth. So there's a lot to like, but I think we have to be very cautious in the go forward with this company, and I have to downgrade it for now. I have submitted, again, 2 out of the 3 articles on this ticker over the last several quarters. I think I'm limited to making 1 article per month on each ticker, but I definitely will, hope to, revise my outlook on Seeking Alpha as well with, a well fleshed out analysis. Again, it's not financial advice, just my opinion. But yeah, definitely think that, there are some elements of concern to see in the earnings report here, as we might see with some of the other earnings reports we're going to take a look at, and definitely something to monitor. So if you found this useful, please consider liking the video, subscribing to the channel, and comment, let me know what you think. And I'm going to get to the next video, and I'll talk to you soon. All right, thank you so much for watching, and have a good day.